I'm going to go through the easiest way that you guys can invest in property and how to beat inflation using REITs. Hi, this is Mosh. I'm an amateur trader investor, and I'm going to go through the 4 best REITs that you can find on the market today with very high dividend yields. Currently in the UK and around the world, inflation is around 7% based on the CPI data. This is an annual inflation rate chart of 1972 to 2021, and you can see how much it fluctuates throughout the years. Around last year and up to this year is around 7% as it currently stands. And remember, inflation eats away at your wealth. If your salary hasn't gone in line with inflation, and if your investments aren't giving you what inflation is, you're actually losing money. So bear that in mind. Historically, REITs, real estate investment trusts, have done much better compared to the S&P 500 during high inflation points. So if you look at this chart, this is a comparison of REITs compared to the S&P 500 and what happens during different inflation periods. So as you can see, during low inflation, the S&P 500 outperforms REITs. During moderate inflation, S&P 500 outperforms REITs. And remember, the Bank of England and the US Treasury, they want to keep inflation around 2%. Now, the key thing is here, during high inflation periods, REITs, so real estate and property, outperform the S&P 500. And I'm going to show you the 4 best REITs I personally think that you can find on the market. Remember, this is not financial advice, it's my opinion, and I'll go through the data and show you each of those REITs and why I think they're the best. So make sure you stick around to the end. Secondly, why do I think it's the easiest way to invest in property? The traditional method is very, very costly. Think about it. If you're buying a house for £100,000, you need a minimum of 10% deposit. If you're doing a buy to let, you need a minimum of 25% deposit. So £100,000 house, you're going to need £25,000 deposit. On top of that, you have solicitor fees. On top of that, you have estate agent fees, because if you're going to let it out to tenants, they're going to do all the paperwork and vet the tenants for you. Now, another issue arises is you can get bad tenants. So they might not pay the rent. You're going to have to chase them up, go to court. You might have to refurb the property. When they leave, you might have to do a bit of work on the property to get it ready for the next tenants. You might even have loss of income where a period of time there's no one in the property. So it is a lot of hassle. So personally, for me, I will be investing in REITs because I just think they are the smarter and the simpler way to invest. First on the list is Realty Income. And I really like this company, and it's very, very well known. It's the ticker symbol with O. They are a monthly dividend company. They actually pay monthly dividends. They are also a dividend aristocrat. So they have been paying dividends and increasing dividend for a number of years. So if you go to the company overview, and just if you're not sure about who they are, it's just a quick overview of the company. They have 2 key values. So this is the vision and values on their website. To grow and maintain reliable real estate portfolio to pay dividends to shareholders every month and secure access to low-cost capital to support real estate acquisitions that increase earnings. And if we just go onto their portfolio page, so they have around 11,000 commercial properties with an occupancy rate of 98.8% and 60 different industries. So they are well diversified. They don't have a specific market in terms of property. So for example, if they're 100% in residential properties, then that would cause an issue. Not only that, they are in 50 states in the US, Puerto Rico, United Kingdom, and Spain. I think they are very well diversified, and it reduces that risk greatly. Now, if we start looking at its share price, I'll just go to 5 years so it gives you an overview. So you can see it reached a peak around $78 in 2019. Then obviously it took a big dip during the pandemic. Now it's starting to climb back up. It's at $67. And the best thing of all is they pay around just over 4% dividend yield, which I think is a very, very healthy yield for this real estate investment trust. Next on my list, and you might not have heard of this company, is called the Supermarket Income REIT. It's a UK based REIT. Now, the reason why I really like this REIT is because their clients are supermarkets. Now, if you're in the UK, you know supermarkets are not going anywhere. Even if we go into recession, people still need to buy food and they still need to go to the supermarkets. So I think supermarkets are there for a long time, no matter what it is, Aldi, Tesco, Sainsbury's, whichever one that you go to. So if we quickly have a look at their portfolio, they have 41 direct stores, and based on a joint venture, they have 26, and they've located it around the UK. If we go to the directly owned portfolio, you can see it's a 1.5 billion valuation that they have. The passing rent is £77 million, and they have a dividend yield of 4.7%, which I think is really, really good. Now, if we look at the financials of Supermarket Income REIT, based in the UK, and we go to the 5-year share price, you can see the share price has actually been climbing because the supermarkets have been doing really, really well. But as we know, during high inflation periods, REITs do very well. Now, if we start looking at the dividends, this dividend I think is really good. It's at 4.72%. And you can see historically they have been paying very good dividends because supermarkets are not going anywhere. They will pay the rent because supermarkets' costs are passed on to the customers and customers have to eat. Next on my list is Civitas Housing PLC REIT. Now, I really like this one. Now, I know some people may be uncomfortable with this because it's based around social housing. So if you're not sure how the UK system works, people that are on very low incomes or unemployed, they will generally have social housing. Those social houses are given by the local council, so they're essentially government funded. As you can see, if we go on their portfolio, they have 649 properties and just over 4,400 tenancies. Now, if you're a private landlord, you might get a bit worried that you don't want people on housing benefits as a tenant because that can cause a lot of issues. They might not have enough money to pay. When it comes to big companies like this, they have contracts with the government. So if we go to About Us and it says supported housing is funded 100% from central government with a 24-year unbroken commitment. So they have a contract with the government for 24 years and it's an unbroken contract. So the government have to fulfill that contract. And because the money is coming from the government for social housing, this company is not really going to lose out because they will recover the money from the government if the tenant cannot pay based on the housing benefit. Now, if we actually start looking at the numbers, and the ticker symbol is CSH, and let's quickly look at the 5-year share price. You can see the 5-year share price has actually dropped. It's on 85.06, and on its height around last year it was about 117. Now the key thing, let's look at the dividend. This is where it really does very, very well. So if you look at the dividend yield, it's 6.25%, which is ridiculously good. Okay, so it is a very, very good REIT to have for a high dividend yield. And you can see the historical yields have been very good as well. So it's always between 4 to 6%. And sometimes even higher than 6%. My last REIT that I want to talk about is the Medical Properties Trust REIT. They have hospitals around the world. If we go on to who they are and what they're about, you can see they're known as the world's leading source of capital for hospitals, experiencing and unlocking the value of hospital real estate for growth, preferred by top operators around the world. And you can see they are around the world. 60% is in the US, 20% in the UK, and then you have other places around Europe as well. If you go and have a look at the portfolio, they have a total portfolio worth 22.2 billion, 440 facilities around 10 countries, and they have around 46,000 beds. The reason why I like this is, again, if we do go into a recession, people still need hospitals. People still need healthcare. They need medical care. So they need to go to the hospital. And to be honest, during a recession, during hard times, the amount of people that are admitted to hospital will probably increase. It's unfortunate, but generally that's what tends to happen. Now, if you start looking at the numbers for Medical Properties Trust, let's quickly look at the 5-year share price, see how that's doing. You can see it's starting to dip. So there was a peak in 2020 and last year as well. and it's on about $18 at the moment. And the key thing is, if we start looking at the dividends, you can see again, very good yield. So 5.78%. Okay, and you can look at the historical yield, and it's always between 4 to 5% yield, which is very, very good. And remember, during high inflation, REITs do much better than the S&P 500 based on historical data. And remember, I'm not a financial advisor. You have to do your own research. And remember, there are many, many more REITs out there. And remember, you can buy these REITs on Trading 212 or Free Trade, which are both free investment apps. And you can also get a free share worth up to £100 by using my link in the box below. Open up an account, deposit £1, and you get that free share. And remember to give this video a like and a sub, as it does help the channel.